Thank you so much for the kind introduction. And the topic is very near to me, because it talks about money managing mantra. Now, mantra is a very scientific term. If I go because I'm a healer as well, like I'm sure in the introduction you've known. And what mantra does is that it has its own variation, and whenever you apply or whenever you use those mantras in those specific conditions, the result or at least the probability of success becomes higher. So what exactly it means is that over a period of years, when we keep practicing and we keep doing those mantras, we are actually making our way of getting the success at any given point in time. That's also very much possible with respect to markets. And right here, the panel that we have here, they have 2 to 3 decades of experience using those strategies, and they know when the success lies in whatever condition, because the variations will help in a down condition or in a high condition. So on that note, I think let the magic begin, and let's get on with the discussion with our panelists here and get to know what are their secret mantras of managing wealth. Now, I'll start off with Mr. Shah. Anand sir, tell us, what does it take to be a contrarian investor in the current market conditions?
Hi, very good morning to all of you, and glad to be here. I think contrarian investing is fairly, not well-defined term. And let me start with that. What contrarian investing means as far as ICICI Prudential is concerned. So a lot of times people think contrarian investing means being opposite. That's completely wrong. So it's not about being opposite to what most of the people do. At times it's also, if I were to extend it a little bit and saying, yeah, it's different, it's being different. Again, not fully explaining what contrarian investing is, To be very honest, contrarian investing is about a little bit ahead. At times it's very painful, but it's all about being ahead and thinking ahead rather than really being in. And that's a truly long-term investing. To be very honest, we over years been talking about long-term investing being 15 years, then we brought it down to 10 years, now we're bringing it down to 5 years, now we also try and saying, 3 saal to hona chahiye mindset, But to be very honest, investing is long-term, and there, if you are 1 year or 2 years ahead, it means nothing, to be very honest. You can never be bang on that, this sector is going to start doing well tomorrow and I will be invested today. No, it can't be. Having said that, in India, talking about being contrarian investing, enough and more opportunities. I'll give you more recent, the way we have sort of investing today in manufacturing for last 18 to 20 months. Again, luckily for us, it's already playing out, but we could have been ahead. We could have been 1 year, 2 year ahead. But I think that's where we are today, that, you have to think what is not. So for last 10, 15 years, something has not worked, and we are saying it's going to work. There's a lot of science behind it. There's a lot of studies since 2014 we've been doing around what's happening globally in manufacturing, particularly in China. When you're talking of manufacturing, we're not discuss China. And China is turning significantly in terms of where they want to focus on. And that throws up significant opportunity. So at times you are ahead, but the whole idea is where it's not about what companies and sectors did well last 10 years. It's about what are the companies and sectors which are going to do well in next 10 years. Where is the highest earnings growth rate? But more importantly, earnings growth rate is just one part. There are two contributors to wealth creation, earnings growth rate and PE multiple expansion. It's well less understood, but the PE multiple expansion has been a big driver of alpha, and that comes with return on equity. So the next step is which are the industries where the return on equities are structurally moving up, and which are the industries where the return on equities are going to structurally move down. And again, there's a lot of science, a lot of research being done internally, externally, and that's what we keep on looking for companies having good earnings growth rate, but a structural shift in the return on equity in industry. Give you an example today would be a telecom. Telecom last decade was a falling return on equity business. Next decade will be a rising return on equity just because the number of players are down to 2 players or 3 players versus what it used to be 8 and 10 players. That's a simple example I'm talking about.
Absolutely. And in fact, you've put it right, earnings growth as well as expansion of the P multiple. Also, we'll definitely come to, are there any specific approaches that you use? We'll definitely come to that point. Hitesh, sir, let me just come to you. You're a value investor. So, any specific, you've been following the value investment style for all the strategies that you're doing. In fact, I've just come to know that you also plan to start brand PMS. Tell us something more about your investment style, and then probably we'll move forward from there.
Sure, Kshitij. Thanks for your question. Good morning, everybody. Hope all of you are having a wonderful time this Friday morning in this lovely setting, by the way. I think, for a lot of us Buffett followers, life is relatively simple in one particular way, which is, how do you make your investment decisions, and then on top of it, overlay your, the realities of the country that you're operating in and the realities of the market that you're operating in. So we do a lot of research work. We construct a lot of research work based on the fundamental data. And then we love to go over, last 20, 25 years of data, and we have built algorithm based on that.
Right.
If there is one specific area in that, if I can touch upon just to, share some more light on this subject, is our studies on the industry dynamic. So, why do the stocks move up? Why do the stocks improve? Why will the price of anything go up? Now, the first answer to the question is too simple and everybody knows it. There is no point in sharing that, because it was too cheap, so the price went up. But the second answer is slightly more critical, slightly more interesting. You can build something on it, you can have a differentiator, and you can have some kind of advantage, which is a systematic study of industry dynamic. What do I mean by that? Now, the industry dynamic is such that where, what is the level of competitive intensity in the industry. We, all of us, most of us would know here about, Porter 101. But when you actually apply in the country setting, what is the reality of that in India? What is the reality of that in the US? Or the reality of that in some of the other emerging markets? It turns out to be slightly different. Industry dynamic, so if you think about industries in some particular ways, first of all, as investors, what we would care about, that the industry dynamic is in the favor of shareholders. Now, if I may, say something which is not very intuitive, obviously business has to be good for customers and customers have to be happy with it. But in reality, when the business is good for shareholders, now let us talk, say, for example, pharma industry, or for example, say in the case of IT, or let's say commercial banking or NBFC and so on. In the reality, for each one of them, medicines we need what we need, pharmaceutical help we need what we need, Fortune 500 requires whatever complications when they procure. So the providers have an upper hand, and that becomes a part of an important moat for them to kind of continue to grow and make the returns. Conversely, for example, which are the industries which have, almost never created value or destroyed value? I mean, does airline ring a bell? Stocks are listed for longest period of time. Where are the returns? Most of the retail industry, where are the returns? I will not get into names. Or hotel industry, for example. They would be listed for, 20, 30, 40 years. If you look at CAGR terms, they will not be even in single digits. So this systematic study of industry dynamics matter a lot. And we really spend a lot of time on it. Because if you, one interesting data here is this: 75% of the instances of stock outperformance in India have come from 17 industries out of 61 industries that exist in India. If you look at, so MSCI industry classification, we are roughly around 61 industries. 17 industries account for 75% of the instance outperformance. That is what we focus on, and not the balance 44, which will make you do lots and lots of work and barely give you 25. Absolutely. So just to that maybe give you some color.
So absolutely. So you've redefined the Warren Buffett principle or mantra for success to Indianized terms, and that's what the session is all about. How we change one methodology slightly to tweak it to the present market conditions. I think That's where the success is all about. That's where we have to also understand that the relevant experience comes in, because these managers have seen so much of cycles, to and fro movement, the boom and the bust, more than 2 or 3, 4 times. Now, Mr. Ramu, let me also come back to you. What is your investment style, and how are you taking the portfolio forward?
We are just trying to identify the emerging trends. Emerging trends means segments of the economy which are growing substantially better than the overall economy. And these are not cyclical, and nothing could have explained better than COVID period, where every sector went through a rotation of growth, but nothing sustained. So we just focus on what are those emerging trends which can grow substantially better than the economy over the next, say, 5-10 years. Not just 1 year, 5-10 years. And then get deeper into it in selecting stocks within those trends by following certain filters. This is what we are trying to do. To just highlight some of the trends which really interest us, and stocks within that which really interest us. If you look at financials as a space, is a well-discovered space, right? Well covered. We have private sector banks which have created phenomenal wealth to the investors. Now PSU banks of late are creating. But if you look at a lot of our focus, we have allocations to private sector banks, but a lot of our focus goes into identifying what are those emerging companies in the mid and small cap space, which can be structurally growing for the next 5 to 10 years. Not just in financials, in every other trends that we are looking at. So if you look at the financial trend, there are those smaller companies which are participating in this financial inclusiveness story. And they're creating a good model. It's not like going and lending, because lending is easy, but collecting is very difficult. But we are seeing emergence of selective companies, not many of them, 5 to 10 companies we can say, who are able to create a good model and kind of bring in people from unorganized lending to organized lending. This is a space where we see a lot of activity. We also see a lot of activity happening around exports. What IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what we think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what we think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space, what India can do in it. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do in Earth. We think slowly IT and pharma did in the global space what India can do.
And hence we were underweight on tech despite the long-term trend in tech and IT being strong. On the other hand, if you look at what was happening on the PSU banking space, for nearly a 6 to 7 year period, in PSU banking, everything that could possibly go wrong went wrong. And as a result, multiples contracted and things on the ground were turning around. So the question to ask yourself was, what expectations are built into PSU banking? Are those expectations real or behind the curve? If that is the case, if they are behind the curve, then is this a good investment opportunity? Even though in the long term, this is a sector which will only give you trading bets or trading opportunities. And then taking your call, what sector should you be overweight on, which sector should you be underweight on? That is what we try and do, identify expectations that are built into stocks and sectors, and bet against those expectations in many instances, which in a sense is what Anand was speaking about, contrarian investing. And it involves being optimistic yet circumspect. And that balance is what we try and bring to the table.
Absolutely, Anshul. In fact, you highlighted a very relevant point here that the customer is usually looking at a shorter time frame period whenever they are evaluating any business opportunity or whenever they are evaluating any PMS or AIF fund with respect to that. And yes, we have to create that kind of value in the short term as well as for the long term. Now, Anand, let me come back to you. So you are a contrarian investor. So how are you identifying those opportunities?
So I think it will be a very long answer.
No.
It's
Things will get a little bit more pointed now. This is the second round of questions.
yeah. No, so I think before I move to what we do internally in order to identify businesses which will grow earnings and potentially have a higher P multiple in the times to come, also on the back of higher ROE, and there's entire philosophy and process behind it. Couple of minutes on point raised about investors. I think there's no way any of us can create wealth for all of you without your support. Why I'm raising this point very importantly, because it's a teamwork. And that's where I want to just spend a minute on investor behavior side also, on what support we need from investors to create the entire alpha for the investors, or the wealth creation journey of investor has to be the teamwork. And there I want to make a point that from the investor's point of view, you need to appreciate the difference between risk and volatility. I think risk is the permanent loss of capital, volatility is a temporary loss of capital, and whether you like it or not, volatility is very inherent to equity market. To say that I will invest in equity but I'll not have volatility in the interim period, I think you're taking, actually if you minimize the volatility, you will minimize the returns for yourself. The idea is to minimize the risk, and that's where all of us comes in. Our experience, our research team, our ability I would not use ability, but our continuous effort to identify businesses which will do better in the times to come is, is a way to minimize the risk. Do we have businesses in our portfolio which are duds, which will fall by 50, 60%, 80%, 100%, never come back? I think that is what we avoid. But the volatility will remain in the portfolio, and that's where, two to three things you can do. Obviously, this entire concept of SIP, STP is one way to minimize the impact of volatility. But even mindset-wise, you should be prepared that things will go wrong, market will be volatile. I think that is first step, that before you come into any equity product, you need to have very clear in your mind that there will something or other thing will keep on going right and wrong both. Market will go up. Also, eventually the market will go up as it's been doing for last 22 years. But in the interim, you will have to have a journey where there will be a short-term loss to your portfolio value. Uh, the second, what comes to your rescue and actually can benefit you is provided you embrace volatility and benefit from volatility, which means is where you are prepared for the short-term losses, and that's where you can up your investments. That's where the asset allocation and everything else comes in. Coming back to a couple of minutes on what we do, I think philosophically we believe it is companies that create wealth and not markets. The other important thing is to stay away from the noise. In the short term, you might want to believe that if the Nifty goes up, the components of Nifty will go up. HDFC Bank will go up, or Infosys will go up, or a Reliance will go up. But in the long run, the Nifty is going up because HDFC Bank is going up, because Infosys is doing well. It is the individual companies which in turn is driving the market, not the other way around. And to that extent, continuous focus on identifying businesses, again coming back to having good business run by good people, good management, and valuation. This is good business, good management, reasonable valuation is generally common in all the investment philosophy, but executing it day in, day out with a very strong research team of 21 members. On top of it, we have an investment team of 7 members. We do that day in, day out. There's a philosophy, there's a process behind it. Very difficult to replicate for individuals, but nevertheless, that's what we come into. We minimize the risk and let volatility be benefiting you in the long run.
I think you've explained it beautifully, the volatility and the risk part. And Hitesh, let me also come back to you. So right now, the talk of the town is inflation, be it global inflation or be it India inflation. So how is that impacting your brand portfolio?
So we actually, we have been worried on the count on inflation maybe
Yes.
for around 8-9 months now. First thing about inflation, we have to know inflation is a PE killer. What inflation will do, it's going to force the central banks around the world and the people who are managing the economies to tame the inflation. And unfortunately, to tame the inflation, the instruments available to the central bankers are very limited, and then they're very blunt, such as, and the main one that is their control over the interest rates and so on. And therefore, we see a meaningful rise in the interest rates, and therefore, it becomes easier for investors to move to safer assets. And if they are going to get 8.5%, 9% return at much lower risk as versus in equity, then there is some shift away from equity into less risk asset versus equity, which is obviously a more risky asset class. So, so how do you manage that? Obviously, so which is why what we do comes into play here, which are the two things in the value investing side. One is, therefore, idea is to find where the valuation is not expensive and P's are, there is nothing much left on the PE on that account just to contract. We have hardly anything in the portfolio which will be like 40, 50, 55, 60 P's, and there are substantial number of stocks inside of BSE 200 with very high P. So that is one part of it, and we really watch our portfolio P very closely, and that really matters. The second part, it brings me back to the industry dynamic, because the companies, when they are doing good, they are doing well, there is some inherent momentum to their good work. You will find that now it's not necessarily very topical for last 1 year or 2 years or so on, but some like Asian Paint for a long period of time, for Infosys for a long period of time, for a Sun Pharma for a long period of time, in case of Bajaj Finance and in ICICI Bank for a very long period of time, and so on. So, and then lastly, what I think uh, is what really matters to our customers and the customers that you all would kind of bring to us is that what original thinking has gone into the work that we do, what kind of businesses that we have found. Um, so when I was sharing with you about good industries remain good and bad remaining bad, and therefore for the shareholders, we are also very much interested in the ordinary industry becoming good, and vice versa. Say for example, conversation that took place on PSU Bank, and Anshul touched upon it some while ago. Uh, and so there was a phase of time when the dynamic they became really bad, and there was a bad landing, and the books needed to be cleaned up and so on. But the fundamentals have substantially been cleaned up, and kind of we saw it early, and that really helped. Or another, point that Anand brought up some time ago, telecom was a wonderful industry. It was a good industry, then became very ordinary. It became bad for shareholders, and turn around when the number of people, number of players reduce, then again becomes attractive. So these are the kind of steps we take when the inflation is kind of coming and going to bite, and take the P multiples down.
Right.
You have to build a portfolio that can become resilient through the quality of the industry that you're in, inside of the quality company that you're in, and what is the portfolio valuation.
Right. In fact, Mr. Ramu, we touched upon the export theme, and right now there are global uncertainties. So how is that theme is likely to play out probably in the next few years' time, or for the long term?
See, exports overall, we feel that it's not like every segment where India is trying to do succeed in exports, we have been successful. We have not been. And that is where we differentiate between different products where India has been able to deliver a sustainable growth over a very long period of time, and why they have been able to do it. And that is how we find that in IT space, what we have done, in pharma, what we have done, it's not only labor cost advantage. And only area other than these two where we find India emerging very strongly is chemicals, as I said, specialty chemicals, not the commodity chemicals. I don't think we will be able to compete. Still Chinese in the commodity chemicals, and they are back with a bang now as we speak. Just on the other points, that little bit of a contrarian here.
Right.
This is where we stand out.
Okay.
See, PSU banks, we have talked about it. We don't try to swim against the tsunami. It can help you for 1 year, but it will not help you for 5 years. Yes, they have done well, but what are they doing today to gain market shares from others in the space? Are they doing anything that they will be able to sustain growth for the next 5 years?
Right.
Yes, there was an NPA issue. It is getting solved today. But what is that they are investing in today for them to confidently say that we will win market share from private sector banks, particularly say an HDFC or an ICICI or an Axis? Or what they will do to defend the turf to protect from the digital companies which are coming up? Okay, 1 year is a period you can make money here, then I have to next year search for another area where I have to make this money.
Right.
I think that makes us very tired. Better is, that 1 year is fine with us, but next 5 years, if this company will gain market share substantially because of the trend, which is very favorable to that company, we would rather play that. That's the contrarian view that I have on the panel.
No, absolutely. Anshul, let me come to you.
Just to add,
absolutely.
It is a very interesting topic that, India has not been very successful in many. Actually, India has skipped the manufacturing. So India actually moved from agri to services. We have a very large financial services industry, IT services industries and whatnot. But manufacturing is something we missed out. Entire decade is lost. And partly that's also to do with China being, head and shoulders above. So it's not only that India has miserably failed in manufacturing in the last decade and a half. It's actually the entire manufacturing outside China has suffered. But things have been changing since 2014 in China.
Okay.
China becoming prosperous will actually be more conscious of pollution. It doesn't have as cheap a labor as it had a few years back. The government policies have changed, and that's where I see emergence of more manufacturing sectors actually doing very well, not only in domestic. So import substitution will be big, but even in the exports market. So that's something to watch out for.
Sure. In fact, things have been changing since 2016 as well here in India, the Make in India campaign, which our government is trying to push in. and hopefully that will also play out in the next 10 years' time. But taking the conversation forward, Anshul, let me come back to you. How's the India-focused fund? Is this version of the fund is different from the previous version of funds?
We continue to do what we do, which is, as I elucidated earlier, which is identifying.
Is the sauce different now?
Source remains the same, absolutely. All we are doing is identifying companies which are misperceived by the markets today. What really, one of the reasons why you're looking at the new name is because people were focusing earlier more on the style of investing, less on the opportunity. And our endeavor was to bring their focus to the opportunity, not to the style of investing. And in everybody's wisdom, the market believes that value is a bad word. We believe understanding of value may be incorrect, but value is a theme which will run through cycles. Our understanding, the market's understanding may be incorrect, which may lead to subpar returns. But I mean, who can say that if someone is to give you $1 for 50 cents,
right,
you shouldn't take it? That is the concept of value. And we believe that it will ride through cycles. Just the understanding of value may be incorrect. So to that extent, the portfolio remains the same. It's just the name which focuses more on the opportunity, less on the style.
Right. In fact, are there, how are you identifying opportunities? So that approach also remains to be the same, or?
Absolutely.
Absolutely.
Absolutely. As I said, our endeavor is to identify opportunities where there is misperception on the street, and take advantage of that. I mean, many times the earning power of a company, for instance, a company may be doing today 6% EBITDA margins, but the earning power of that company may be 10% EBITDA margins. And this 6% may be a temporary phenomenon. But what happens is that when the company is doing 6% EBITDA margins, the multiples also compress. And when that trajectory from 6 to 10 moves, as someone was mentioning earlier, that leads to ROE expansion, and that leads to, in a sense, multiple expansion. That journey is what we are trying to run through and play in our portfolios. So identification of opportunities, the style of investing, all of that remains the same. Just, it's like the cover has changed, the goods remain the same.
Very nice. Very nicely put there, Anshul. In fact, we all are same, the way we are growing up. It's just that the value system remains to be the same, but the way we dress, the way we move, the way we talk becomes different. But at the end of the day, we all are same from the core, the value system, yes. Mr. Shah, let me quickly come to you because, yes, we are running out of time. And very quickly, how's return of capital is there for managing money or creating wealth? How is that important factor?
As a money manager, we always have a responsibility when an investor gives us money to identify the best ideas where you have enough and more opportunities on the wealth creation. But having said that, among the value systems you spoke about,
right,
honesty, hard work, humility, I think we did come across a point of time when we actually, in our PIPE portfolio, which is more of a small cap to mid cap journey portfolio, we didn't find many and attractive opportunities. And that's where, with humility, with a lot of honesty, we told our investors, look, as we speak today, we are not really finding opportunities in this space. While there are opportunities in other space, we went ahead. We actually took a drastic step of returning capital to all the investors, those who didn't switch into the other, and that worked out very well. Again, it could have worked either ways, but I think that's where the asset management's value systems, our ability to be humble and honest that we are not finding opportunities, that would be the case today, say in a wellness portfolio, suppose. I'm just giving you an example where at some point of time we might not find attractive opportunities enough, we will go out and tell investors. So these are the things which we can do more on the sectoral funds, more on the mid cap, small cap, where once in a while we will have to accept that there are not enough opportunities at this point.
Right. Hitesh, very quickly, is there a right mix for core and satellite portfolios? Is there always at any given point in time?
I'm sorry, I didn't get it.
Is there always a right mix for core and satellite portfolios in the
Yeah, so whatever philosophy I kind of shared,
right?
maybe in last 30 minutes is, we put it to work in the core and satellite fund, and also the brand and equity fund in a separate way.
Right.
But also to add a little bit on this point and to the previous question, because that's what
Sure.
really matters about, all of us are here for good quality, long-term returns for our investors. That's why this event and this conversation. Now, good news is that, because the markets are a lot more matured, we can look at last 15-year data, 20-year data, 25, 30-year data, good quality data available. The reality is that Indian markets have compounded roughly around 14%, 14 to 15% in total shareholder returns over period of time. And I think it will be endeavor of almost everybody everybody on the stage and all the fund managers here to be kind of beating those returns. But the reality is that, when you look at a 15%, 14 to 15% a year versus any other asset class in India, with the kind of liquidity and security that investors get from investing in equities, it's outstanding. And our idea then, therefore, is to, take the best elements of take the best names from it, and then to put it in the fund that we manage.
Right, nicely put there. Mr. Ramu, we've talked about interest rates, we've talked about inflation, not about interest rates, but yes, for your portfolio, which is more export focused, interest rates are the real thing to, sort of watch out for. So how is that really going to impact your segment or your portfolio? How are you dealing with that?
On the earnings front of our companies, zero, because we start when there is no debt in a company. That's how the
Right.
first filter comes. So we don't really worry about what is the interest rates going to do to the earnings of our companies. But yes, on the valuation side, when the interest rates are going up, we generally feel the premium that growth companies get in that period compresses.
Right.
And then when the interest rate starts coming down, the premium for the quality company starts expanding. We saw that happening between 2018, 19, 20 in India, and 21 and even in 22 as money chased market. We saw this valuation compressing between the quality and not so quality companies. Now again, we feel next 2-3 years, as this money is not going to chase anymore,
Right.
probably. And globally, Fed is going to keep on tightening this over a period of time until they feel that economy is not doing anything. Till that point, I think the number of performers are going to come down, and market is going to become very selective. Again, the quality companies are going to get the premium moving forward, in my opinion. So to that extent, we feel comfortable with the way the market cycle might evolve in the next 2-3 years. So this is the point that happens. Market is not in your control. Market cycles will change. There is not going to be one style which will work throughout all 5 years of your investment horizon. 5 year itself, in my opinion, very less sort of an investment horizon for an investor to get the benefit of a fund manager style, particularly when he's a long-term oriented. So I think next 2-3 years could be again good years of as now the interest rates are definitely going to peak out the way the noise is happening, but let's forget about it for a moment. Let's look at, can US sustain a 5% Fed rate for how many years? Not more than 6 months to 1 year, in my opinion.
Right.
When the economy comes down, 40 years they have been cutting down interest rates after 1 year of increase. So what is the interest rates going to be 2 years, 3 years down the line is what the investors' focus should be. I think it's going to trend down after a peak now. Probably FY25 or 2025, we might be talking more about where the interest rates are heading down.
True.
At that point, I think again, equities and particularly companies with growth, good earnings, I think they will outperform majority of others.
Absolutely. I think it's a very relevant trend there as to where interest rates are headed from here on. And I think most of us agree here that the interest rates are sort of peaked out now, and the only way is only down. So probably in the given time frame, we could see interest rates heading down from the US and for India as well. Anshul, let me, yes, we are running out of time, but very quickly, how are these two things, inflation and interest rates, are impacting your portfolio? How are you devising your strategy accordingly and making sure that the wealth is getting created over a period of time?
if there is one thing that I've learned over the years in my, participation in the industry, it is that um, if you have high ROCs in a portfolio,
Right.
and those remain steady, then typically stocks compound in line with earnings growth. And if you have low ROCs, which are going up, that's when you get the benefit of both earnings moving up as also multiples expanding. And the example of late is, in the last year, interest rates have moved up, inflation has moved up. But then what has happened with ITC, just as an example of the stock? The stock has been a rank outperformer in this period. What has happened with, say, a Bank of Baroda or a SBI? They have been rank outperformers in the last 1 year to 1.5 years. The point I'm trying to make is that it is, while you can, with a broad brush, say that inflation and interest rates moving up will lead to multiples contracting, but it doesn't play out in individual instances. And that's the kind of framework that one should have, that given the conditions that run today, despite those conditions, how can we make money in the markets? Our belief is that there will always be money-making opportunities. Money chases those pockets where the trends are in favor, that is earnings growth is there, as also ROE expansion is there. It is left to us as fund managers to identify those trends. And our endeavor as a fund manager, and to be able to add value to clients, is to identify those trends, sub-trends within the market, and make money thereof. That's what I would say. In general, inflation and whatever is happening because of inflation, interest rates will impact us just as much as it would impact any other fund. But the ability to identify these sub-trends is what we believe differentiates us.
Right. Well, on that note, I think thank you so much for your time, gentlemen, and we wish you all the very best for your future endeavors, as well as managing and creating wealth for your customers. Thank you so much.